In this video, we are going to talk about financial statements. Same financial statements you already heard from your accounting classes, and we're just going to do a little review and then talk a little more about them. So the standardized financial statements, you have, as you remember, your balance sheet, your income statement, and these are useful for comparing financial information and from year to year or to other companies. So we're going to talk about those items there. Now, we also have the statement of cash flows, but for this chapter, for this section, we're going to talk more about these two. So financial ratios, you should be somewhat familiar already with them, but they are ratios that we can calculate from the financial statements and to give us insight on different aspects of a company. Or when you're comparing with a different company, some things may be different between the companies and it'll be difficult to compare the actual dollar amounts. But when you have the ratios, it's more like comparing apples to apples. So you're kind of like putting them in a same playing field, an even playing field. We have liquidity ratios or short-term solvency. Just like it sounds, it measures the liquidity of a company, their short-term ability to handle cash is the most liquid one, but then we have other items also. But it's also for short-term, so they have enough cash on hand to operate. Financial leverage ratios. These are long-term solvency ratios. And as the word suggests, financial leverage, we're talking about long-term debt here. There are other debts that are not long-term that can be used in there. However, the bulk would be that. Assets management. So if you remember from the balance sheet, assets equals liabilities plus equity. So assets are everything you own in the company, all your factories, all your computers, all your machines. So the question is then, well, how are you utilizing these assets to make money in the company? And are you doing it efficiently? So if you got two companies, one has a lot of assets and one has very little assets, but they're making the same money, then the one with a little bit of or less assets is going to be doing better. Profitability ratios is about profits. So in a business, money comes in, you pay off your expenses and costs, you pay those out, and then you are left with your profit. So the question is, from the money that comes in, how much are you keeping? And that's profitability ratios. Market value ratios. As you know, when you account for your assets, for example, there's depreciation issues, and eventually some of these, let's say, buildings that you have depreciate to zero. However, the truth is you can still sell assets at market value. And that's just one example. So there's another type of ratio that is away from the books, to put it that way, the book value, in order to see what the true market value is. And it's an important measure to use. These are a few examples of the ratios that we talk about, where these ratios, most of them or all of them, you should have seen already in some of your previous classes. If not, then if some of them are new to you, they work the same way as the other ones. Current ratio, current assets divided by current liabilities. So all of them have a short, quick formula you use to calculate them. But what's more important at this level is how to interpret that information. For example, current ratio is current assets over current liabilities. Now, this is one of the ratios that you prefer to be higher instead of lower because you want to have more assets than liabilities. However, like many other ratios, not all of them, having it too high could be a bad thing also. So these are one of those ratios that you want it higher better than lower, but you don't want it too high either. How much is too high? There is no set figure. It just depends on the industry you're in, your business profile, and a lot of other aspects. But just at least understand that. So the rule of thumb is higher better than lower. But always keep in mind that, yes, there is such a thing as too high, because then you're not being efficient. You're not efficient at using your assets. Quick ratio is just another form of current ratio, but we don't include inventory because inventory is probably the least liquid one. It's just a little tougher ratio to meet. You got your cash ratio, total debt ratio, and so forth, so on. And these are how you calculate them. The word EBIT, I always like to bring it up because sometimes in your previous classes, you hear the term operating income, but you don't hear the term EBIT. So understand that generally speaking, when you see EBIT, is the same as operating income. And all it means is earnings before interest and taxes. Here are a few more ratios and how you calculate them. Please refer to the textbook to understand what each one of them means, and if you want them to be higher or lower. If you have any questions, always contact the instructor as well. And more ratios. I should also add, even though we just saw 3 slides full of different ratios, there's a lot more. There's a very long list of ratios, and which ones a company chooses to pay attention to, it depends on the company. Also, for those that move into more advanced finance and accounting classes, you're going to see later that some of these ratios may have more items. It's still going to be called, let's say, let me see a good one here. Inventory turnover. It may have a few more items in here that they consider. And because these ratios can be modified or amplified in order to address industry specific unique characteristics. But this is the starting point. Now, I want to bring your attention here to return on equity, which is a big one in the finance world. Notice a return on equity here, we have net income over total equity, but we also have ROE as a net income divided by sales multiplied by sales over assets multiplied by assets over equity. These two calculations will give you the exact same number. However, they don't give you the same information. And I'll do a light introduction explanation to this. And it's called, this one here, the one more, the longer one, is called the DuPont identity. And it's named after the person that decided to develop it. They both give you the same information, mathematically speaking. Let me go ahead and show you how. For those that remember algebra, if you have numerators and denominators, you can cancel them out. So sales can cancel sales and assets can cancel assets, leaving you with net income over equity, which is the same one here. But why bother with expanding it? There's a lot more piece of information you get when these are separate ratios that are being calculated. As one example, here, net income divided by total equity, you cannot tell how much debt there's in the company. You don't have information about the liabilities. However, when you expand the formula with this last piece here, you can tell how much is in liabilities because you have the total assets and you have the equity. The difference would be the liabilities. The point is that if this number here is a very high number, then that means the company has a lot of liabilities. You would not be able to tell that by just looking at this up here. So a company may have a high return on equity, which seems like a good thing. If you just calculate it this way, you wouldn't have an idea of the risk of the company. But when you look at it from this angle, a high, we can call it equity multiplier, a high figure here in this ratio, assets divided by equity, tells you, okay, they have a high return on equity, but that's because they have a lot of liabilities. So there's a riskier company. However, they had a high return on equity, low liabilities, low, not, I didn't say no, low, or maybe no, sometimes they have zero debt, then something to look into. But that will be the idea. And you can get then other information as well from sales over assets for efficiency and things like that, and profit margin here. But that's the purpose of why expand it, so you can get more information out of it. Here's the same thing, the DuPont identity. Now notice you have net income over sales, sales over total assets over total equity. And as we said, it still gives you net income over total equity, but you have more information. This is the leverage. This is the asset use. And this is the profit margin. That's why you got profit margin, total asset turnover, equity multiplier. So the DuPont entity is saying that return on equity equals profit margin total times total asset turnover times equity multiplier. But as I said, that's the reason to expand it, is you can get more information. We will stop this video here and we'll continue the rest of the chapter on the next video.